Hello, regulations are very important for the safety of public, the business and the wider economy. In this video, we shall see four of the important regulatory acts which are applicable in BFSI sector in the USA. BFSI stands for Banking, Financial Services and Insurance. Let's get started. If there are no regulations, many financial frauds can happen in the corporations. Lack of customer data protection or customer protection in general, wherein customers are sold some products which are not very good for them. At the same time, it may be good for BFSI to generate more revenue and more profits. Banks can become conduit of illicit activities. That is the third thing which can happen, and economic instability for the whole of the country which may happen. So the first one is the SOX, the Sarbanes-Oxley Act. It is for corporate governance and financial reporting transparency. So we want the organizations, the firms to be very, very transparent in reporting their balance sheets, income statements, cash flow, everything. If they don't report it, that means that they are giving wrong signals to the economy. They are giving wrong signals to the investor public also. Gramm-Leach-Bliley Act, privacy and security of individuals' non-public personal information. So these BFSI are having access to a lot of information about a customer. It should be kept secure and it should be private. It should not be distributed to the common public. So that is what is enacted with the help of GLBA. Bank Secrecy Act. So it aims to detect and prevent money laundering activities by requiring reporting and record keeping requirements. So if in case a lot of transactions are happening for an individual or a firm, it may be because of some illicit activities which are going on. Probably the money is being transferred to some organization which is threat to the nation. So how can we control that? We can control by checking that the money is not rotated without purpose. That comes under the purview of Bank Secrecy Act. CFBP. So we saw that in 2008 2009 there was a subprime crisis wherein individuals were not able to pay their loans, the house loans, the mortgage loans, and they had to bear a lot of hardships during that time. So we wanted to ensure that the consumers are treated fairly by institutions and have access to transparent and understandable information about financial products. In 2008 2009, the loans were given to the customers without them meaning the customer understanding the loan product in detail. So that's where this regulation has come to protect customers from purposeless overselling by the BFSI. Now the one important thing is why SOX is highlighted here. SOX is highlighted because it is meant for all the corporations and the other ones are meant only for the BFSI sector. So this is meant for all the corporations, which means that this is applicable for BFSI, banking, financial services, and insurance also. The rest of three are typically for BFSI sector only. So Sarbanes-Oxley Act, which is also called SOX, aims to enhance corporate governance and financial reporting to prevent accounting fraud to the investors. So what was the precursor? Why it came in existence? It came in existence in 2002 post the dot-com bubble. During and after the dot-com bubble burst, some very high-profile corporate scandals were identified. These scandals eroded investor confidence, highlighted the weakness in corporate governance and financial reporting, and demonstrated the need for regulatory reforms. In response to these events, the US Congress passed the SOX Act in 2002 to restore trust in financial markets, enhance corporate accountability, and strengthen the oversight of public companies. And we all are aware of this Enron scandal, WorldCom, Tyco, Adelphia scandal. So all these things, if we have to see only one of them, Enron was once one of the biggest and most admired company in US, and it collapsed in 2001 due to widespread accounting fraud. So what is accounting fraud? Accounting fraud is when the accounting of the organization is not proper. The executives are reporting profits, but the organization as such is not seeing any profits. So these are deceptive accounting practices to conceal the company's financial losses and to inflate its profit. So that was Enron, and that's where the SOX was incorporated. So it has three sections. Section 302, it requires CEOs and CFOs, Chief Executive Officers and Chief Financial Officers, to certify the accuracy of financial statements and disclosures. 404 mandates internal controls assessment, requiring management and auditors to evaluate and report on the effectiveness of internal controls over financial reporting. And the last one, whistleblower protection. This is also very important. So what happens is that if you are working in the same organization where this fraud is happening, if you report this fraud, then chances are that there would be some retaliatory actions which would be taken against you. So with this act, what happens is that it provides you protection. It provides protection to whistleblowers who report violation to the SOX. The next one, the number two, is the GLBA, Gramm-Leach-Bliley Act. GLBA is designed to protect the privacy and security of non-public personal information. What this information is, we are going to see it in a bit. Personal information may be the customer's name, address, phone number, social security numbers, government identification numbers, passport numbers, date of birth, etc. Financial information is basically the account number, the balance, the income and credit histories, loan or credit card application information. So those kind of information. Transaction, as the name says, when you perform any transaction in the banking entity, those transactions should be kept secret. Withdrawals, transfers, etc. should be kept secret. And the last one, information from third parties. So what are the third parties? So for example, credit score is fetched from a credit bureau, which is a third party. Your income information is fetched from your income statement, which is given by the organization where you work. Employment information is also given by the employment organization where you work. So all these are coming from third parties. This personal information should also be kept safe. That is the purpose of GLBA. Bank Secrecy Act. So what happens is that if in case there are lot of transactions which are happening for any customer, there is a potential that those transactions are happening because of some illicit reasons, and this Bank Secrecy Act requires financial institutions to establish and maintain anti-money laundering AML programs and report certain transactions. So what they have to report? CTR is currency transaction reports. So if in case there is any transaction which exceeds $10,000 or more, that should be reported. Suspicious activities reports. So financial institutions are required to file SAR to report suspicious transactions that may indicate money laundering, terrorist financing, or other illicit activities. The last one, the fourth and the last one, is Consumer Financial Protection Bureau, CFPB. So let's see what was a precursor. In 2007 2008, there was a financial crisis and it led to severe economic downturn, highlighted widespread issues of irresponsible lending. So the keyword here is irresponsible lending, deceptive practices, and financial products that harmed customers. Many consumers face foreclosures, high levels of debt, and loss of wealth. And why this happened? One of the prime reason which led to this financial crisis is that the banks had not done due diligence. They had not informed to the customers on the repercussions or their financial liabilities which are there, and they were just very concerned about making more profits by selling more products to the uninformed customers, and that led to such a big financial crisis in 2007 2008, and thereby this CFBP was formed. So what are the objectives? Ensuring that consumers have access to clear and transparent information about financial products and services, preventing unfair, deceptive, and abusive practices in financial industry, promoting financial education and literacy among consumers, supervising financial institutions for compliance with consumer protection laws. So this concludes the presentation. Hope you are able to make a good understanding of the four important regulations which are there for BFSI, banking, financial services, and insurance. The fourth one being SOX. Thank you very much.